Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. In this video we will be doing an analysis of Domino's Pizza and seeing if it would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Now, let's go ahead and jump right in. Cue the logo. Let's start with the recent earnings report for Domino's Pizza. Earnings per share for Q3 2023 came in at $4.18, beating analyst estimates of $3.30. However, revenue fell 4% to $1.03 billion for the quarter, which was just shy of analyst estimates of $1.05 billion. While earnings growth is strong, revenue growth seems to be slowing. Let's check the charts. Starting with the 1-year chart, we see that Domino's Pizza had a CAGR of about 4%. Zooming out to the 5-year chart, we see that Domino's Pizza had a CAGR of 5%. Domino's Pizza share price has been climbing over the long term but has been in a pullback for the last 2.5 years. This may represent a good buying opportunity. Let's explore more by looking at the fundamentals. Gross margin is 27%. This is very good. Revenue has compounded at around 7% over the past 5 years and has reached nearly $4.47 billion on a trailing 12-month basis most recently. Notably, this is a 12-month period in the last 5 years that revenue comes in lower than the previous period. Good gross margins are a positive, but slowing revenue may be an early cause for concern. Looking at cash flow, we see a 5% CAGR over the last 5 years in operating cash flow, while capex has decreased at a CAGR of 8%. As a result, free cash flow has grown at a 9% CAGR. This is very good. Domino's Pizza has been doing a great job of reducing their capex over time. Now let's turn our attention to share count. Domino's Pizza has been decreasing their shares outstanding at a rate of about 4% per year, going from 43.3 million shares in 2018 to 35.5 million shares most recently. This is a great example of strong share buybacks. I really like Domino's Pizza so far. Now let's view return on invested capital. Return on invested capital has fallen from 80.2% in 2018 to 53.6% in 2023. Though the trend is downwards, Domino's Pizza has been a tremendous steward of investment capital over the years. A return on invested capital of 53.6% is excellent, and the trend appears to have bottomed in early 2023. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 11 days in 2018 to 17 days most recently, Domino's Pizza efficiency has worsened over the long term. However, similar to return on invested capital, the worst cash conversion cycle value was in early 2023, so the signs of Domino's Pizza's improvement are evident across multiple metrics. Last, let's explore Domino's Pizza's debt. The net debt to EBITDA is 5.4 and is just slightly improved from 2018 when it was 5.8. Here is the big bruise for the company. The debt level is just way too high. So, the fundamentals of Domino's Pizza are actually pretty good. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Domino's Pizza. It is a restaurant company with a gross margin of 27%. The 5-year revenue per share CAGR is 12% and the 5-year free cash flow per share CAGR is 14%. While this seems like a small win, it is actually very outstanding that Domino's Pizza has been able to have such strong revenue and free cash flow growth. A return on invested capital of 54% is quite amazing, and the short term is improving. We will have to watch closely to make sure the new trend continues. Next, the cash conversion cycle of 17 days is not very high, but it would be great if the company could get this value to below 0. Concerning debt, a net debt to EBITDA of 5.4 means that Domino's Pizza could pay off all of their debts with about 5.5 years of earnings. That is way too much debt. So from a fundamental standpoint, Domino's Pizza is okay, but the debt load is worrisome. Now let's switch our attention over to valuation. Domino's Pizza is nearly fairly valued relative to the S&P 500 with a ratio of 1. The price to earnings growth, or PEG ratio, is 1.9, which shows that Domino's Pizza is a little overvalued compared to its projected earnings growth. Overall, Domino's Pizza is a well-managed company. The strong free cash flow growth is very hard to come by in today's macro environment. With both return on invested capital and cash conversion cycles starting to turn around, this might be a great buying opportunity. The biggest challenge for the company is aggressively lowering their debt. According to their earnings report, the company has $81 million in cash with $5 billion in debt. With interest rates so high and expected to remain high for the next few years, a high debt load could spell disaster for the company if not addressed. At this point, I would rather see more funds funneled to improving the balance sheet than to buying back stock. The share price has a bit more to fall before entering the buy zone for me, but it is close and I will be keeping this company on the watch list. Many thanks for watching. What do you think about Domino's Pizza and its massive debt? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.